Now, family members and listeners alike, as we roll into the new year of trading and investing, we're talking about 2018, I want to make sure that those of you that are making a series of mistakes, we're going to call them the top 3 bad investing habits, okay, of traders and investors. I want to go over those 3 terrible or investing habits and make sure that you are familiar with these particular, shall we say, negative behaviors, and you do not implement them during this upcoming year, 2018, as you trade and invest. Now, if you practice bad investing habits, you may as well burn your money, because no matter what the market is doing, you will not get P.A.I.D. Now, the following insight that I'm about to give to you can help you identify and halt those bad habits before they get worse and cost you a fortune. Now, over the past 20 years, individual investors averaged a measly 2.53% a year versus the S&P 500, which chalked up 9.02%. In other words, beloved, your average annual return was 6.49% less than what it could have been each year. Ouch. So, what's going on here? Well, when you look back over the last 2 decades, 2 things are readily apparent. A, that the markets have been rocky, and B, that there's plenty of blame to go around. The Fed, the big banks, bubbles, China, Washington, Wall Street, the ECB, it doesn't matter. There's a long list of reasons why. But at some level, they are all guilty. But you know what? Those 2 factors that I just mentioned are actually not the primary causes that doom millions of traders and investors to poor performance. No. The real culprit is, it turns out that every trader and investor is hardwired to do 3 things that kill their profits, that kill their returns. And that's what I want to discuss with you today. You see, these bad investing habits, if you will, are there for one simple reason, okay? And if you understand what these costly behaviors are, recognize them in yourself as you become honest with yourself and learn how to eliminate them, then you can build wealth much more quickly. And you can absorb the market and absolutely beat the market on an ongoing basis. Now, it's an afterwards wealth institute tactic that ranks right up there with picking the right stocks and controlling risk. So let me explain these 3 terrible things that traders and investors do, and let's look at a way and means of not doing these things. So here we go. Let's get cracking. First of all, there's something that's called recency, spelled R-E-C-E-N-C-Y. Recency, okay? And it's called recency bias. Now, recency bias is the scientific term for when short-term focus trumps long-term planning and execution. Let me repeat that. Recency bias is the scientific term for when short-term focus trumps long-term planning and execution. It's what happens when somebody yells fire and everybody runs for the exact same exit at once, despite having entered through any of a half a dozen doors in a particular auditorium or theater. You see, family members and listeners alike, this is why momentum trading works, for example, or why the news channels seem to cover the same stocks at nearly the same time, because a large number of people are focused on exactly the same companies simultaneously. Case in point is the Bitcoin and the cryptocurrency craze that's going on right now. Logically, they then become the subject of increased attention and tend to move more strongly or consistently. The question of why is the subject of much debate amongst human behaviorists. But I chalk it up to the fact that human memories tend to focus on recent events more emotionally than they do longer term plans that are put together with almost clinical detachment. Simply put, recent knowledge overrides long-term thinking and memory. And the more extreme the events or the news, the sharper our short-term focus becomes. You see, this is why emotion is the one investing tactic you should never, ever, ever use. It undercuts absolutely everything you do as a trader or investor. At the end of the day, okay, family members, if that doesn't make sense, think about what happened on November the 11th. Think about this, okay? Most of the world's major markets bottom within minutes of each other on short-term panic and emotion. Then when the trading resumed days later, they began to climb almost in sync with one another, as highly localized events once again faded into the longer-term fabric of our world. And that brings me to the next bad investing habit you must absolutely avoid, and that's running with the herd. Bad investing habit number 2 is running with the herd. Listen to this strange phenomenon. Humans would rather be wrong in a group than right individually. Let me repeat that. Humans would rather be wrong in a group than right individually. So the vast majority of traders and investors tend to make decisions and mistakes in masse. You see, you can see that in the market data suggesting we have a fine tradition of doing exactly the right thing at precisely the wrong time. You see, instead of buying low and selling high, most investors tend to sell low and buy high, further damning themselves to subpar returns. Now, a lot of studies suggest that this is indeed the case. You see, there was a recent study that was performed that analyzed the records of a major investment firm from 1993 to the mid-2010. And the work included analysis on more than 1.5 million interactions between the investing firm and its clients. And there was a staggering finding. The value of investment advisors is not so much in picking stocks, but in keeping clients from impulsively trading at the wrong time. Okay? And the study found that aggressive orders cost clients about 4% a year. In other words, investors act against their own best economic interests with alarming regularity and cost themselves huge amounts of wealth in the process. So, it is thought that this is because society tends to form social groups based on affinity rather than simply becoming a collection of isolated individuals. That's why investors tend to magnify the importance of information you see in the herd around you rather than breaking from the herd before it goes over the cliff. Now, when it comes to money, we see this in a phenomenon known as chasing returns or following the hot money. This is why annual performance issues, that you can access either through Forbes magazine, Money magazine, or Kiplinger's, for example, are so irresistible and also very dangerous. And that brings me to fear. The number 3 bad investing habit I want to give to you that you gotta control during 2018 is letting fear move you or paralyze you. I repeat, letting fear move you or paralyze you. Right now, as I speak, millions of traders and investors are sitting on the sidelines completely paralyzed by plain old-fashioned fear. And who can blame them? Yet I would argue that fear actually contributes to both recency and herding, which I just discussed with you. That's because it causes people to sit on cash that should be invested or redeployed, in trading and investing, as opposed to just keeping that cash sitting on the sidelines idle, generating no revenue or meaningful revenue and income. You see, clearly, bad investing habits work together to keep you from the returns you deserve. And studies show that this comes down to pain. Losses hurt. They hurt financially and they hurt emotionally. Nobody likes them. That's why people are more likely to let a losing position go against them than they are to take profits, because they can't take the pain of being wrong. The fact that they are unprofitable becomes almost irrelevant. Okay? And yours truly can attest to that, having helped hundreds upon thousands of investors over the years navigate today's complicated markets, okay, through my various webinars and radio broadcasts and classes and sessions and the like. That's why here in the ASK THE WIZ Wealth Institute, we do everything we can to enforce the discipline of taking profits and minimizing losses in careful concert with an overall strategy and or plan. It's why both tactics and risk management are an integral part of the ASK THE WIZ Wealth Institute process. You see, by breaking the recency factor and eliminating the herding mentality that went with it, okay, then you'll be able to find that many times fear is no longer an issue. 3 things that you must control in 2018 as a savvy trader and investor. 1, you must make sure that you do not engage in recency, okay? Recency bias. Next, make sure that you do not run with the herd. And third, do not let fear move you and or paralyze you. Now, when we come back,